Module Overview. IFRS 15. Revenue from contracts with customers is a comprehensive standard issued to bring consistency and transparency in the way entities report revenue. It replaces several older standards including IAS 18 revenue, IAS 11 construction contracts, and related interpretations like IFRIC 13, IFRIC 15, IFRIC 18, and SIC 31. IFRS 15 introduces a five-step model that all entities must follow to recognize revenue from customer contracts. The goal is to align revenue recognition with the delivery of promised goods or services and reflect the amount the entity expects to receive in exchange for those goods or services. The five-step revenue recognition model. The core principle of IFRS 15 is an entity should recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled. Step 1. Identify the contract with the customer. A contract exists when there is agreement, written, verbal, or implied, rights to goods, services, and payment terms are identifiable, the contract has commercial substance, and collection of consideration is probable. If a contract does not meet these criteria, revenue is not recognized. Step 2. Identify the performance obligations. Performance obligations are the distinct goods or services promised in a contract. Key considerations. A good service is distinct if the customer can benefit from it on its own or with other readily available resources. If goods services are bundled, determine whether they should be separated or treated as a single obligation. Example: a mobile phone sold with a data plan equals 2 separate performance obligations. Step 3. Determine the transaction price. The transaction price is the amount of consideration an entity expects to receive. Adjustments are made for variable consideration, discounts, rebates, bonuses, time value of money, for significant financing components, non-cash consideration, consideration payable to the customer. The goal is to estimate the most likely amount or expected value using probability-weighted outcomes. Step 4. Allocate the transaction price to performance obligations. Allocate the total price based on the standalone selling prices of each performance obligation. If standalone prices aren't observable, estimate using adjusted market assessment approach, expected cost plus margin residual approach. Allocation must be proportional and justifiable. Step 5. Recognize revenue. When, or as, performance obligation is satisfied, revenue is recognized when control is transferred to the customer, either over time, e.g. construction, long-term services, or at a point in time, e.g. sale of goods. Indicators of transfer of control include legal title transfer, physical possession, customer's acceptance, risks and rewards passed. Contract modifications. Contract modifications, change in scope or price, are treated as separate contracts if new goods, services are distinct, and price reflects standalone selling prices. Part of the original contract, if not distinct modifications, require reallocation of transaction price and may need retrospective or prospective adjustment. Disclosures under IFRS 15. Entities must provide sufficient information to users of financial statements to understand nature, amount, timing, and uncertainty of revenue and cash flows. Required disclosures include contracts with customers, disaggregation of revenue, contract balances, receivables, contract assets, liabilities, performance obligations, significant judgments, changes in estimates. Special considerations in IFRS 15. Licensing revenue, recognized either over time or at a point in time, depending on rights transferred. Non-refundable upfront fees. Revenue not immediately recognized unless a distinct good or service is provided. Warranties. Separate performance obligations if they provide additional services, else accounted for cost provisions. Repurchase agreements. Evaluated to determine if control is actually transferred or if it's a financing arrangement. Case study, applying the 5-step model. Scenario: a telecom company sells smartphones bundled with a 24-month service plan. Application: Step 1. Identify contract. Yes, formal agreement. Step 2. Performance obligations. Smartphone plus service plan. Step 3. Transaction price $1,200 over 24 months. Step 4. Allocate $600 to smartphone, $600 to services. Step 5. Recognize smartphone revenue at delivery. Recognize service revenue over 24 months. Comparison table. IFRS 15 versus IAS 18. In this module, we will be using feature, IFRS 15 and IAS 18 in our table. 1. Revenue approach 5-step model based on risk-reward transfer. 2. Performance obligations, focused, not defined. 3. Allocation of price based on standalone prices, often not addressed. 4. Contract modifications, detailed treatment, not covered. 5. Disclosure requirements, extensive limited.